All right, we got 2 minutes until we are going to get this thing underway. Now, just under a minute to go before we get things started. So, thank you to those of you who are patiently waiting for us to get it going. 45 seconds. And that is the timer. There we go. Let's knock this off the screen and let's cut back to the full screen. Is this working? Perfect. Let me get more centered. Now we're ready. Welcome back to another weekly HT stream. This is the second stream we've got with a webcam, so I think we've worked out some of the technical flaws. I think we're looking a little bit better, and we're ready to talk about what we've got for this upcoming week. We could quickly, high level, we are in a 2 week hole that we're trying to dig ourselves out of. But as of right now, when the market closed last Friday, the S&P 500 was at a yearly low. So if you and your account balance are above your yearly low, you are beating the market, from that point forward. So that's all that we try to do around here. But even better, we are still, sticking to our original goal of breaking even on the year in October. And that's something that the S&P 500 and NASDAQ are a long way away from. So let's cut back to the screen share, throw me in the bottom left corner, and we are going to get this thing going. So to recap last week, there were a lot of trades that we could talk about. A lot of trades we added during the week. SPX spreads, we were hitting those every single day, sometimes multiple per day, and those worked out really, really well for us. But all in all, we took home a profit of $4,163, which is phenomenal, especially in the face of a 2.92% decrease in the stock market. So the one thing that we were a little bit worried about, right? We have this strategy where we bend, but we try not to break. And we were bending a lot, right? If you look back through the history here, you'll see a 3% drop, a 4% drop, a 1% drop in the market. Like this stretch, it's crazy to look at, right? If we go back to the week of just August 14th, and let me zoom in a little bit further on that. But even just the week of August 14th right here, the S&P 500 was at $427.10. And in just over, it's about a month and a half, we have arrived at the closing price last Friday of 357.17, which is a crazy, crazy drop for such a short time frame. Excuse me. But with that said, the way our strategy works, for those of you who follow us, you guys know the drill, I'm sure. But we keep averaging down, we lower our break-even price, and we work ourselves into these positions and scale into positions. So when the market decides to bounce back up, we're in a good position. And the way it works, we didn't do a very good job of it at the beginning of the year, and I think this is helpful context when we talk about what's been going on throughout the course of the year. You see, January, we were in way too heavy on positions. April, kind of similarly. But moving forward from there, we adjusted the strategy, be a little bit more conservative up front, maybe start smaller position size, targeting some more aggressive strikes, so that the dollar payout is the same, but the amount of risk we have on the table is less, which is great for these types of conditions in the market. And as you can see, since May, I mean, we've made over $30,000 in the market, despite the fact that the market over that period is down about 12-ish%. So I think we've really adjusted well to a volatile market. We've handled it well, and we escaped September, despite the fact that we had a big red week in there, right? Since the beginning of July, we were on a roll. We had won 11 weeks in a row, and then we finally had the inevitable red week. But the idea is that we scale into those positions and we put ourselves in a position where that can be recovered very, very quickly. Now, $12,000 is a decent loss for 1 week, and we never want to try to make that big of a loss all back in 1 week because that can lead to something like this, and we're definitely learning our lesson from that. But with that said, we escaped September with a loss of only $2,000, which in the context of our account size, that's a 1.21% loss compared to an 11.87% decrease in the S&P 500 over the same period. So that's the worst month of the year so far in the S&P 500. Yeah, we just escaped with the 1% loss, which, sucks to lose money. We're in the market because we want to make money, but sometimes you have to accept that when the market drops 12% in a month, it's okay to lose a little bit of money that month. Our goal is long-term outperformance. We've accomplished that this year. And since we started publicly tracking our trades in July 2020, we are, crushing the S&P 500 and NASDAQ from an outperformance perspective. So stick to the plan. Move into October, we're going to try to get this year-to-date profit back to zero. And let's talk about, quickly reflect on last week, and then we'll talk about our plan for the upcoming week. So last week, the big concern I had was we talk about that bend but not break strategy, and that's kind of the reason I went on a little bit of a tangent right there, because we had the boat loaded pretty heavily, right? If you look at some of these position sizes fully cash secured, we were over 100% fully cash secured. Now, if you compare that back to the beginning of the year, there were times we got up to 170, 186, 215 at one point, and that was just not good because that led to these $23,000 losses, 8,000 in a week, 8,500 in a week. So we want to avoid those up front, and we have, right? We accomplished that goal. Now, I don't think there's anything wrong with getting this number, back up towards 150, maybe at the peak, but I definitely don't want to be entering into a week with that at like 150 or 200. Going into next week, it's at 95.61%. So I think from that perspective, we're well sized for next week, and we cut down on a few positions. We could run through that in a second. But the big worry I had going into last week was that, we lost 12 grand. Now we're in all these big positions. If the market drops again, what if we keep losing and we keep, dropping and digging a bigger and bigger hole? But it's great to see high level that the market dropped 3% and we were still able to make money. And that's with a little throwaway loss on MNMD where we got pretty unlucky there and lost $1,400. So even with that and the fact that the market dropped, we still made a decent bit of money last week, and that's phenomenal. It was powered by those SPX spreads. I want to talk quickly about those SPX spreads because we're starting to run away with some profit here. I think a couple weeks ago, maybe a week or two ago, we hit our first, I think we hit our 100th spread. But lately we've just continued to hammer them, and we are on a winning streak of 24 trade cycles in a row for the SPX spreads. And over that period, we've made over $6,000, and that's just in the back half of September. Overall, with our SPX strategy, since we started putting it into play and tracking at the beginning of May, we've taken home over $15,000 on that. So we've been hammering those, and just it's a volatile market. I don't really like to hold anything overnight, and there are some that we have held overnight, and they are the bearish call credit spreads. These are very important because since it's a bearish call credit spread, they're going to make us money when the market goes down. So to protect ourselves when the market's dipping day after day after day after day, we keep hitting these bearish call spreads day after day after day after day. And, getting $300, $400 at a time really adds up. And as you can see, we took home $2,800 almost from the spreads. And that's with UVXY included in there. If you isolate the SPX trades that we had, that's $3,175 worth of profit on those spreads. So that was a fantastic development. That went really well. Some other things that went well for us, DraftKings, we sold 16 strike puts. We had $1 of premium knocked off those, so we took home $1,900. Now we want to have that $12,000 loss week in the back of our mind because the idea is, look, if we recover on all of those positions individually, we're going to get back to where we want to be. But if we look 2 weeks ago, right, we lost about $3,700 on DraftKings. So if you net that out with what we did this week, it's an $1,800 loss and, manageable. So we put ourselves in a position where we could roughly take home, please load, $1,400, right? We're not going to get it all back, but we're going to get close enough to zero where if DraftKings just gets back up to 16 this week, we pull a really nice amount of money and we get, I think we put ourselves in a position where we could make back this amount over a 2-week period. SoFi dipped a little bit further on us, but the premium on that one was really good, and we only ended up losing about $140 on it. So one of those losses that you don't even really need to think about. One thing that did go against us pretty decently is Peloton. That one we lost $810 on last week, and it really slid like crazy. Like we could pull up the, if we pull up the Peloton chart here, PTON, this one really started having the legs get cut out from under it in the back half of the week, right? Thursday morning, they actually had some news that I would think is kind of bullish when they announced that they were going to be selling some physical bikes in Dick's Sporting Goods. And that's what you see with this green candle right here, but that thing was quickly given back as it opened at about 820-ish. Before the end of the day, it was actually below 7. So that is a really, really big move against us. If you look in the past like 10 days, Peloton has just been sliding. But if you, the premium's manageable, right? So we actually made a trade breakout tab here to explain the process that we're moving through with Peloton. It's down to 693, but here's the deal, right? We started with the 9-strike put that we lost $320 on. This past week that we just looked at, we lost not $790 more. So we were in a position where after this last Friday, we were losing $1,110 on Peloton. So what we want to say is, okay, our goal right now is just to break even. We don't want to get greedy and like sell 8-strike covered calls and take assignment and go to something that just isn't too feasible for Peloton. Because again, the thing that we want to keep in the back of our mind is that things can always get worse in the market. So we want to protect ourselves from further downside pain. Just being able to tread water and keep your head above the line, so to speak, when the market's moving down like this is super, super important because like it's an easy game when the market starts going back up. The big goal that we have is making sure that, when the market goes down, we don't lose so much that we can't recover when it comes back up. But with that said, we were down about $1,100 on Peloton. So we said, okay, if we just look at the trade and the P&L, that $1,100 loss, what could we sell next week to get us $1,100 back? And we didn't hit it exactly, but we split, right? We had 20 contract size. So we split the 20 between 7.5 strike puts and 7 strike puts, where if Peloton rebounds back up to 750, we're going to get $990 back on that. We're going to make but we'll get back to a $120 loss. And when you're in a situation where if Peloton goes back up to 7.5 and you have a stock that you've been playing to drop 23% on you in under a month and you could get back near break even, I think that's phenomenal. So that's what we did with that one. And yes, we're not going to be able to get all of it back, but even just getting to that smaller loss overall, right? We have an unlimited time frame in the market. We just want to take things week by week by week. You're always going to be able to trade next week, so don't take yourself out of the game to where next week, you can't get anywhere near break even. Palantir went really well for us. We stayed, I think smartly so, but we stayed conservative with it this week on a 7-strike put, and that thing I think finished. I don't know if it finished above 8, but it was definitely flirting with it. Let me take a peek. 813 is where Palantir finished at. The chart on that one was, if I could spell, incredible. Completely against the general flow of the market. So that one went well for us. Not too much to say about that. Open Door dropped a little bit, but again, we sold the 3.5 strike calls on the spike, so we got $330 a call premium from that. It's a $90 profit on Open Door, despite the fact that it went down. Now, if we get a little bit lower, we go into TQQQ, which has been moving against us decently because that one is just a leveraged QQQ stock. So it is directly tied to the NASDAQ. So with that said, yeah, when the market goes down, this one's going to go down. But what we did do well is that, yes, there was a $2,000 loss on the shares that we had. However, we were able to bring in $1,600 worth of call premium. So even though the market took a pretty big step backwards, on a net basis, that's only a $400 loss, right? And spoiler alert, it nets down to a $4,000 gain on the week. So, making sure that your losing trades are small losses so that the winners can kind of drive the momentum for your portfolio is super, super important. But we could talk about that with what we got set up next week when we get down here. AMD, that one, we actually added a 64 strike put on Thursday, and it's another great example of when you get a red Thursday in the market, you could set up some 1 day or 0 day, I guess if it were a Friday, right? We saw this general trend. We saw with Peloton, the same thing happened with AMD, right? When you see a big red Thursday, what you can do is sell a 1 day to expiration option, and you could usually get some pretty good premium on it. If you look at the 64 strike put that we sold on AMD, we got $1.17, meaning that as long as AMD stayed above 62.83, we were going to make profit on that alone. So as long as, and funny enough, the actual low last week was 62.83 on the number. So it never even got into a position where, even though it did continue to move against us a little bit, that option never even got into a position where we were going to lose any money on it. But again, we had 2 contracts here, right? The initial contract, and this is us playing defense. So the initial contract lost $80. Us playing defense made us back 76. $4 loss. And if you look at AMD's 5-day chart, we can go to the 5-day. This is what it did last week. Peaked at 68.8, finished at 63.36. If you could walk away from that big of a dip with a $4 loss, I think it was right there. Yeah, that's a pretty flexible strategy that we've thrown onto that one. And we similarly have an Amd Trade Breakout tab where we have then rolled into the 67 strike puts. And again, we started playing AMD when it was at 76.15. So it isn't just this 68 to 63 drop that we're looking at that we were able to brave last week. It's a greater overall drop in the context of the entire month here, where we got in at 76-ish, right around here. Continue to drop to 63, and we're still in a position where if it jumps back up to 67, I think next week, we're basically going to be break even, right? That $41 loss is nothing. So as long as we get back up here, we could break even. And again, we size back down to 1 contract for 10/7 expiry. So if we want, we could take a look at that option chain that we've got coming up next week and say, hey, if we really want to lower our break even price and AMD keeps slipping away from us, there's a lot of premium on these out of the money puts right here. Even selling just one of these, if we elected to go with the 63 strike put, for example, for about $1.85 of premium, since that's doubling down, that $1.85 of premium is a direct cent for cent reduction of our cost basis. So our cost basis would be around 65.20-ish for the whole trade. So that's a pretty solid place to be at. And that's our cost basis if we're not assigned. If we're assigned on that, it goes even lower. So tons of flexibility here, but again, we want to go into the beginning of each week with a good amount of cash. This market is super volatile. There's nothing stopping it from going down even more. So if we do cross that bridge and the market does continue to slide, we want to use that cash that we've set on the sidelines in order to size back into these larger positions, as opposed to taking as large of a position as we can at the beginning of the week. Ford, I think this one was solid. It moved against us a little bit, but Ford is a stock that I'm happy to be investing in, especially at these levels. If we take a little bit more of a macro view of the Ford chart here, right, it's dropped down from 15 to 11. I hated it when it ran up to like 20 plus when that was happening about 6 months ago, but I think this 1150, 12-ish area is a fantastic place to invest in Ford. It has a 6-month low of 1061. If we back the chart up to a year, that's still the 1-year low. So I think we're going to have a decent bit of support in this area, and Ford is a decent company to own. And there's decent premium on a week-to-week basis. And if we think about these trades in like a 2-week window, yes, this past week we lost 330 on it. We sized into 20 contracts, but what do we want to do? We want to size down positions and try to make back money with smaller positions. So what did we do for next week? We sized down back to 10 contracts, and we sold an 11.5 strike put, where even if the stock just stays flat, we're going to make $120 back. And if it jumps back up to 11.5, as we anticipate that it might, because RSI is getting very, very low on it, if it just has a 30-cent jump next week, guess what we're going to be looking at? A $420 gain back. So a 420 gain net against that initial 340 loss, or 330 loss rather, means that we'll be making money so long as it just gets back up to 11.5. And remember, we started playing this thing when it was low 12s just a week ago. So that's a good example of how flexible this is. And once again, importantly, we sized back down to 10 contracts, where we had 20 contracts this week because this is the initial trade. This is us playing defense. For the coming week, we have the initial trade, and we now have that buying power back, where if it continues to drop, we can play defense again. So our break-even price on Ford is like 1130-ish or something like that. And if we look into this upcoming week, if it does continue to slip, we could do the same thing, where we sell like an 11 strike put, and that drops our break-even price to 11, almost on the number. So lots of flexibility there as well. Going further down the list, Shopify was a great one. We love that 27. We liked anything around 30. It broke that 30 level of support. So 27 looked good. We bagged $190 off that. Nike was a great one. We made 153 bucks on this one, and I think it was in less than half an hour. If you take a look at Nike, this is a great example of some things you could do at the very end of a week post earnings, right? So they reported earnings Thursday night. So what that means from an option selling perspective is that implied volatility is getting super high, right? It builds and builds and builds, and then after earnings are announced, it comes back down. And if we go back to the 5-day chart, you're going to be able to see that a lot more easily. But what you'll notice is, yes, this does look like a little bit of a cliff, but this is like 9:30, 9:35. This is when the market opened. This is 0.48 out to the right. I'm sure the numbers are super small on the screen, but it dropped even more as the day progressed. So those first, 30 minutes to an hour of the day, there's still a little bit of residual implied volatility on the stock. And what that means consequentially for those of us selling options is that there's going to be a little bit of inflated premiums at market open as well. So we were able to sell these things for 60 cents. And we got out of them for 10 cents, I think, within the hour. I would have to check the trade alerts again, but easy 153 bucks. And yeah, 153 bucks is not going to make or break your year, but if you start adding up this 190, this 150, the 305, those numbers start adding up. We're not going to have one trade that's going to make our week. We're going to have a collection of smaller base hits that work really nicely together to bring us a nice portfolio and give us a result like what we had last week, where we made 4,100 bucks despite a 3% drop in the market. UVXY I think has been really, really interesting. I love the theory behind this trade that we're in. Yes, we lost 150 bucks on it last week, and we've done 2 weeks of it so far, and we're down money on it. We lost 430 the first week, 160 the second week. I have tweaked it a little bit to where we have historically been targeting this 50 cent, kind of max profit window, and we still have that set up for the coming week. But what I'm doing is selling a little bit closer to the money on the call credit side. So what that means is we're going to get a larger credit. I think the biggest mistake we made is that a lot of our risk on this UVXY combo trade, and if this doesn't make sense to you, I made an entire YouTube video on it combining cash secured puts and call credit spreads on UVXY. So take a peek at our YouTube channel if you want an explanation as to how this one works. But the idea is that the risk is really more so on the high side, right? Because if this runs up, there's not a lot you could do with the spread. You're going to be looking at max loss. So to combat that, we want to get the biggest credit that we can get. We're selling these call credit spreads $1.50 wide. So the closer we can get to $1.50 of overall credit on the trade, the less upside risk we're going to carry. So if we look at what we did this most recent week, I think we did an awesome job of this. So you'll look, we got a 44-cent credit plus a 71-cent credit, meaning that max profit for us if UVXY finishes between 12.5 and 13 is going to be $1,150 for us, which is great, right? It would take these first 2 weeks and make those losses look irrelevant. It would crush those and put us green overall on the trade. But with that said, what I really like about this is that it mitigates a lot of that upside risk that we talk about, right? Because previously, if UVXY starts running up to like 13.5, these are formulaically driven, this credit's going to get bigger and bigger and bigger and bigger up until 14.5, where we have our max loss because that's capped. What's great about this week is that our complete max loss here is only 350 bucks. And something very interesting about spreads is as you get to the end of the week, you don't have to take these down to the wire and let them expire. So what we did last week on these 11.5 13 strike calls, the call credit spread, that is, we were in a position where if it finished where it was, this would have been worth like $1.40. So we had the opportunity to close it for 103. And that's a significant departure, a 103 debit to close from the 150 debit to close at max loss, right? That 50-cent difference on a 10 contract size represents 500 bucks. So I think the idea and the approach we want to take here is, look, if you're running hot on these call credit spreads, not a big deal. Just close it a little bit early so you don't lock in that max loss, right? We want to treat the call credit spread the same way we treat the rest of our spreads. And rule number one with all those is that you never want to take max loss. So with that said, if we run into a similar situation next week, the market continues to slide and we're running into that upside risk on UVXY, I imagine we could probably have a pretty similar close for like $1.03, for example. And with that said, we're still at a profit overall because of the enormous credit we got on the 12.5 strike put and the larger credit that we got on the call credit spread. And I think that's a really nice feature of what we've got set up for the coming week. And again, our max profit window is anywhere between 12.5 and 13. We're going to be hitting that max profit of 1,150 bucks, and UVXY could drop all the way down to 11. Oops, I'm in the wrong cell here. But UVXY could drop all the way down to 1135, and we still won't lose a single cent because we're getting 440 off that call credit spread before we lose 440 off the cash secured put. They cancel each other out. So high level, what we're getting right now is just this really huge window of break even, right? Our break even for the upcoming week is between 1135 and 1415. If we pull up the UVXY chart and take a look at that, between 1135 and 1415. One, you have to zoom out. So 1415 is up here, and 1135 is all the way down here. So if we look at this in like I guess this is the 5-day chart, right? So as long as UVXY stays between these levels for the upcoming week, we are going to be making money on UVXY, and I think that's a very nice value proposition because yes, UVXY can be a very volatile stock. It's a leveraged VIX-related instrument, so it's inherently volatile. But even with that volatility, right? We think about how volatile the market was last week, which caused VIX to be very volatile, right? It went from 1151 to 1355 trough to peak. But even with that volatility, if you look at the profit range that we have, it never got outside of these red lines. So we have an enormous range of profit for the upcoming week. And we have this nice little 1250 to 13 range in here where we'll hit that max profit of over $1,000 that we outlined a second ago. So that's the idea with UVXY. I think it's a super, super interesting trade. If I can just update this formula again to bring UVXY back in here. And that's how it currently sits. UVXY finished last Friday at 1285. And that would stick us with 11,150 of profit. But Friday is a long way away from right now. So keep an eye on it. Manage the call credit spread. Take assignment of the cash secure put if you need to. But really, we don't want to touch that one until Thursday at the earliest. Moving down the list, that takes us to our SPX spreads. We talked about those. All in all, great week. Over $4,000 of profit, 2.52% return in the face of a 2.92% dip in the S&P 500, which means we outperformed by 5.44%, accomplishing our goal. And while we had a little bit of a rocky start to the year, where we had, some tough breaks for sure, we've weathered that really nicely. We've adjusted the strategy to, better be tailored to this volatile market, and we are running away a little bit this year from the S&P 500 and NASDAQ. And when you look overall, since we've started publicly doing this in July of 2020, we are just crushing S&P 500 and NASDAQ, which are actually approaching 0% returns on a 2-year basis. So that's pretty interesting as well. But with that said, let's get into what we have for the upcoming week and talk about, yes, we only lost a couple $1,000 in September. We have a rocky market right now, but how are we going to get this money back? So top to bottom, we've got DraftKings. And you'll notice position size here. Position size is super, super important because the smaller the positions, the more flexibility we have to combat a further slide in the market. And I think a really important macro trend that I want to have in mind is we've seen a lot of stocks essentially retrace back down to their, their pre-COVID peaks. So for the S&P 500, if we take a look at that, we go to the 3-year chart here, the pre-COVID peak for SPY was right around 340. So we're really not, we still have another 20 points on SPY until we get back down there. So that's something very, very important to keep in the back of your mind as you continue to trade because, yes, I think short term, we're in a really nice place here for a bounce. We did just break through the support level from back in June where we were previously at the lows. On a 1-year basis, RSI is in the gutter again. We know what happens when RSI goes into the gutter on a 1-year basis. We're typically in line for a short-term bounce. And that's not to say that, the short-term bounce will take us all the way back to new highs. It probably will look something like this where it bounces and then grinds a little bit lower. But we always want to have that little bounce in mind and keep an eye on where RSI is when we're formulating our portfolio and our holdings for the coming week. So with that said, we wanted to keep the slightly larger size. I didn't want to take 20 contracts on in DraftKings like we had last week, but 15 should do the trick at max profit. That's going to bring us $14.85, and that would just require a jump back up to $16 a share for DraftKings. If we look at a 10-day basis on this chart, that really is not much, right? Just 10 days ago, this thing was pushing $19 a share. So that's something that we want to keep in mind. SoFi, 5-strike put. This one we kind of had to throw our hands in the air a little bit and say, look, it's not looking incredible. All right, we lost $670 on that one off the bat. I didn't want to keep the 20 size contract because, again, things can always get worse. So I sized in with 10. It continued to slide, so we can add 10 more contracts. And if we could find, 49 cents of premium, maybe, I mean, let's take a look at it right now. We've got Holmes HC in the Twitch chat. What's going on, man? Welcome to the stream. Looks like we can get 26 now, which is a little bit better. Shout out to Vohio Killer for the follow. Appreciate that. But it looks like we can get about 26 cents of premium if we wanted to add on there. We got a question if we've ever tried futures or if we only do options. So we have messed around with futures a little bit, but admittedly, it's a much more active strategy. What we like to do, and it's great because, I mean, Monday to Friday, I've got a pretty busy job. I try not to be glued to a computer trading all the time. So what we do is we set up our portfolio like this, where we have this base level of positions that we have going into the week, and we kind of let it sit. And yes, there is some active intraday trading that you can do as much or as little of as you would like. But it lends itself to a very nice hands-free type option selling strategy where you don't have to be glued to a screen. Go outside, do something else, go enjoy yourself. But yeah, futures trading, I think if I ever started doing trading full time, that would be something I look a little bit more into. I don't know if More4 is on the stream tonight, but there's definitely a lot of discussion around futures trading in the Discord server. I think we've got, yeah, if I pull up this tab right here, zoom in a little bit, we've got all sorts of futures traders over in the active traders section. So that's good stuff right there. Let me pull that back off. Okay, so back to where we were. Let's go to what we have for the coming week. Let me pull the chat back up so I could see it. Here we go. We've got a quick question from Holmes HC. Any thoughts on this? U.S. stocks have a spotless 8-decade record of rising after midterm elections. And I honestly think trading trends like that is a really, really good idea. I'm sure some of you guys have seen some of the charts of the S&P 500 over the past few months and how it relates to how it looked back, I think, in 2008, and how it looked very similar. You may have seen how the S&P 500 typically trades during the year, and you might see that September typically is one of the worst months of the year in the market. And if you'd traded based on that thesis, that actually played out. It was the worst month of the year in the market. And then typically October, November, December, markets go up. However, I think post-midterm, November and beyond, the market will be a little bit more in the clear. Rates will have risen a little bit more. And the big thing that I think is next in the market is going to be earnings. Earnings are being reported in like second or third week of October is when earnings season kicks back up. We've seen a really big shrinkage in valuation as interest rates rise and, people are less able to get debt. I probably could have worded that a little better, but debt's a little bit less accessible, a little bit more expensive to take out, which hurts some of the growth companies. But what's really, I think, going to lead the next leg down in the market, if we do see it, is yes, we've seen rates rise, but I think the next step of this is earnings, right? You talk about valuations based off of price earnings ratio. Okay, the prices have come back down to reflect a little bit better valuation based off prior earnings, but we're seeing some economic headwinds, and if it starts to be reported that the earnings part of that price to earnings type of valuation is dropping, that's when I think we're going to see another leg down in the market. So this upcoming week, I think we're kind of in the clear a little bit as far as market events, earnings, and things are concerned. So the next couple weeks, I'm really hoping to get back even with this big dip that we had back a couple weeks ago. And then I'm going to tread very, very carefully middle of October. But if it turns out that earnings forecasts are good, we could definitely see a decent short-term rally. And we always want to be in a position where we could benefit from that kind of a thing, right? Because we've chased it all down, right? We've gone down with the market. We've tried our best to average into these positions. It'd be a shame if we gave up on everything and de-risked and didn't catch a bounce. So with that said, I think that's kind of my outlook short term for the next 3 months as we finish out 2022. I mean, our number one goal is just to get back to break even. Right? It's always fun to go look back at 2021 when we said, oh, it was great. We made $94,000. We didn't lose a single month. But in 2021, the market was up like 27%, right? Trading in 2021 was like trading on easy mode. Like we could have sleptwalked through 2021. And it's important to recognize that not every year is going to be like 2021, because if you traded this year like 2021, you're probably getting slaughtered. So I've always said, outperformance is the goal for us. we could finish this year, like if tomorrow were the end of the year and we finish with an $8,000 loss. Yeah, it's never fun to say, oh, we lost $8,000 during the year. But if we take a look at that and say, okay, we only lost 4.58% this year, when the entire market, if you look at the S&P 500, which we track over here, the S&P 500 is down 24.8%. The NASDAQ is down over 30%. So if we walk out of 2022 with a single digit loss, yes, we do want to make money, but that's a win for us. So with that said, I'm off. I always go on my little outperformance tangent. You guys will have to keep me honest and stop me. But moving further down the list, we've got a firm 19 strike puts. Now this is one of, I think, one of my favorite rolls that we had for the past week. We kind of got screwed a little bit on a firm as it was chilling above 19, and we could pull the chart up to better illustrate this a little bit. AFRM. It was chilling above 19, our max profit level, for the first half of the day on Friday. And honestly, every single time that it tested 19 over the past week, it bounced right back off of that level. It wasn't until Thursday morning when it finally broke below 19, but again, bounced back up. On 11 a.m. Friday morning, a firm was at 1970. We thought we were going to cruise to max profit, but as is the case, the market sometimes has different plans for you. As it essentially went in a straight line down to its closing price of 1876. We got out before the little slide at the very end of the day just because we wanted to lock some profit in. But we took home a profit of 890 on that one. Now, again, we want to talk about rebounding positions. If we look at it on a 2-week basis, the previous week from a firm, we lost $1,300. Last week, we recouped 890. That leaves us in a 485 hole. If you look at what we have set up for the coming week, even if a firm just stays flat and we have to close this for a 24-cent debit, that makes us back 480. That puts us profitable overall on a firm on a 15-day basis. And again, if we look at the last 10 days, this is what a firm has done, right? If we could be profitable off of this chart on a bullish position, I mean, that's absolutely fantastic for us. So that's it, right? We want to pay attention to that position size. A firm, we got up to 10, right? Because 2 weeks ago, this was our first position. This is us playing defense, and then we carried that into the following week. And now we have the opportunity to break even with a lower position size, and we absolutely jump on that opportunity because now we have the ability to add 5 more contracts if it continues to slide. And if it doesn't continue to slide, we get max profit. We take home $600 on it. We don't even have to lift a finger on it. Open Door, I still think this one's got some decent potential to run. It's got some analyst stock targets that are up, representing over a 100% return from where it is. We've seen Open Door can make some pretty decent runs if it starts getting going, right? It went from 285 and it started brushing up against that 350 level before a huge red candle down at open. But one thing that I do notice here, right, if we compare this to the S&P 500 over the last 10 days, oops, that's not how you spell SPY. If you compare it to the S&P 500 where it's basically taken a general trend downwards, we take a look at Open Door. Why can I not spell anything? What's going on here? Open Door. Yes, it did have this general trend down, but on September 23rd, it made a low, and it did not get back to that low. In fact, it effectively traded flat between September 26th and September the 30th, which was last trading week. So I think that's an interesting trend to keep in the back of our mind, because if the market bounces, like, we've got some decent proof that this thing can run. Like last Wednesday, the last green day I think that we had in the market, it went from 316 up to 345. So we want to leave a little bit of upside on these shares, especially since we're holding 3,000 of them. And if it really gets moving and goes up to like 4 or something, we're in position to make decent amount of cash on it. But I think more smartly, the approach we want to take is wait till we see something like this, because it's not going to go down every single day. Famous last words, right? But wait for a day like this, then cover the shares. Try to get 7-ish cents. I think right now we can get between 4 and 5 cents on the 3.5 strike put. I really want to see it get closer to 10, like what we did last week, where we covered it for 11 cents. That's $330 you're getting no matter what. And if we could close it for 11, or I guess cover it again for 11 cents, and we get called away, which is, oh no, we get our shares called away, that jump up to 3.5 would represent a $1,080 profit on the shares, and then we get 210 from that. I'm perfectly happy taking $1,300 off the off Open Door next week if that happens. TQQQ, this is one we've been chasing down a little bit, and we've got our own little trade breakout tab here. It's turning into a kind of long one, a circuitous path down to where we are. We started playing this thing mid-November when we off the initial dip, right? We could pull up the TQQQ chart, and I don't know what's happening where these numbers keep getting appended to my searches, but whatever. We played this thing. Let's go to the 1 month chart. There was this huge dip down, and we're like, you know what? This is a big dip. We typically don't like to play leveraged ETFs, but I think something like this, where it represents an overall market, like the tech stock market, uh, it's decently safe with the premiums that it's offering, right? Because off of this big dip from 31.9 down to like the mid to high 20s, we were able to jump in with the 26.5 strike put off the bat for 60 cents a premium, right? That's a 25.9 break even price. So we were in a position where this was our initial break even price, and it had traded above that for the last like 5+ days. So I thought that was a good place to start. Now the market has had other ideas, as it so often does, and continued to go downwards. So what did we do? We scaled in further. We played some more defense. And slowly but surely through the back end of September, we lowered our break even price week after week after week after week until we've gotten to the point that we're at right now, where I need to update this and call this a 10-7-21 strike call. But we sold that for 74 cents a premium, lowering our break-even price to 21.37. Now what you'll notice is we sold 21 strike calls, so we can't technically get back up to 21.37. 21 is the most we can get. But at that point, we're only losing 671 bucks, and that could be easily earned back. I feel like there are better words to say that too. Got to work on the vocab. Anyways, we could easily recover that cash right there if this gets back up to 21. And if it gets back to 21, again, we're in a great position for next week, because look, if these shares get back up to 21, we're looking at a gain of over 6,000 bucks. And I can guarantee you that if TQQQ gets up to 21, since it's an overall market, some of these other stocks are going to be running too. We might be looking at max profit on DraftKings. Open Door might get up to 325-ish, right? And that's how all these trades start to work together. This might get down to like 0.25 and max profit there, and all of a sudden, just with a little bit of a bounce in the tech market to get TQQQ back to 21, we're looking at a very decent profit, right? I mean, I'm sure AMD would probably run up a little bit for us as well. But then you're in a position where a little bit of a bounce, and you combine these last 2 weeks, and all of a sudden, we fully recovered that big catastrophic week, right? It doesn't take a huge bounce. The market's gone down, 7-8% in the last 2 weeks. It's not going to take an 8% bounce for us to get back. Even just a 1 or 2% bounce in the market this week will go a long way and kind of get us back where we need to be. But again, this is base level profit. Unfortunately, we rolled it when it was 20.08, and then it slipped at the end of the day on Friday, which is why we're recognizing those losses right here. But with that said, that 74 cents of premium pretty much makes up for that slide at the end of the day. So we've kind of just got these shares. Good question from Sid Perez in the YouTube chat asking, how would I recommend learning how to trade options? And there's so many different resources out there. It can be super, super crazy. It's like putting the mouth on the fire hose, trying to get all the information. But I think, the hierarchy of information and learning option selling, I think is just understanding general trading in the stock market. And then 2, getting into those derivatives and how option buying works. And then what we do is option selling. So I think you need to understand how option buying works before switching sides to option selling. But with that said, option selling is the best side. So definitely would recommend learning but not deploying an option buying strategy. But there's all sorts of great beginner videos. I think just going on YouTube, I pretty much learned everything I did just from self-research on the internet. I don't really know if I've read any books that too strongly shaped what I've been doing. But yeah, Johnny Felix 23 is chiming in. YouTube is a great resource. Unfortunately don't have any book recommendations, but I'm sure there's some helpful ones out there. But honestly, it's as simple as just searching something like, how do options work, options for beginners, and just getting like a 1 or 2 hours of sitting in front of the computer and just taking all the information in. And then from there, it's going to be one thing I see a lot of people make this mistake is you go learn all this stuff and you say, okay, this is great that I've learned all this information. And I've done this in other areas of life, right? You learn something and you want to put it into place so quickly. And they use their real brokerage accounts and go to the market. And yes, there's some conceptual things that you can learn, and it's great to understand the theory of how options work and how all these things work together. But there are some things I truly believe that you can only learn through experience. So I definitely wouldn't put your money in right off the bat, right? It could be super enticing and you could be super excited and say, oh, let's do it. I'm learned. I'm ready. Let's jump into it. But paper trading as well, I think, is one of the most important things that I could recommend someone. to do. And we got Jules recommending some audiobooks as well at the library for free. So there you go, Jules. Welcome to the chat. How you doing? So there you go. Great question. Always happy to help you get started too. If you want to pop in the Discord server, shoot me a message. I've got some resources I can get you on the right path with. Because at the end of the day, what we do, yes, we do offer a service where we alert our trades, share our research, things like that. But at the end of the day, what we do in our Discord is we want to teach people for free who want to learn how to sell options. And it's perfectly free to learn with what we do. That's why we've got the free streams every week. That's why we've got the free section of our Discord server. I think there's just a lot of bad information out there. A lot of people who are just get so sucked into the idea of getting like a 1,000% return in the market. And unfortunately, people on social media who try to advertise the fact that they can get you that 1,000% return in the market. And you have really well-intentioned new investors who get led astray. So that's kind of the overall goal and why we started doing what we do, for that free education, to kind of have a good resource that people can turn to if they're legitimately interested in learning in the market. So feel free to shoot me a message, and that goes to anybody if you're looking for recommendations about resources of where to start to learn the strategies. Further down the list, Unity. This stock has been phenomenal for us, right? You want to talk about different levels that we can trade with. We go to U. We've been watching this one for a while. If you go to the 180-day chart, we loved it back down at 30, right? I think I've had this red line on here since the summer, right? Because it went down to 29.09. It bounced off of that. Bounced off of it again in June. Bounced off again in July. Bounced again at the end of July, and then it ran all the way up to 60. We're like, I'm not going to go touch this when it goes to 60. Let's be patient. Let's wait for it to come back. And guess what? It's finally back at 32.15. So we know that that low 30s level is one that we want to mess with. And again, this red line, it's been here for, I think, 5 months at this point, but it's still holding true. It's been working really well. So 31.5-ish is a good level of support here. But we always want to give ourselves that little bit of an extra cushion. So we sold the 30.5 strike puts, and I should probably put the date in here to be a little bit more helpful. 10/7, weekly expiry. And that's an 80-cent premium, so we know that our break-even price is going to be $29.70. So as long as Unity doesn't drop 6.78% this week, we're going to be making money on it. So that's the setup we've got there. And Unity's been a great one, right? We talk so much about these positions like DraftKings, SoFi, Peloton, Affirm, where we're like, okay, we had a really bad week. We're trying to get back to break even. Sometimes there are options where you never even have to worry about it, right? So long as Unity stays above 30.5, we'll make 400 on it this week. This past week, it stayed exactly where we wanted. We made 450 off of it last week at that 31 strike. The week before that, the low 30s held their ground. We only made $55, but over a 3-week period, provided again Unity holds 30.5, that's $905 of profit off of a bullish Unity position despite a really, really sharp downturn in the market. So I think that's a great example of how effective some of these higher premium names can be, because yes, Unity has dropped over the past 3 weeks, right? It objectively has gone down. But with that said, since we're selling out of the money and playing these levels that we're confident that the stock is going to bounce off of, as long as it doesn't hit those levels, we're still making money. Yeah, I couldn't care less if it goes down 3% or goes up 100%. We're still making the same amount of money either way. Ford, again, this is one we rolled from the previous week. Another one we want to pay attention to the position sizing, because last week, again, we had the initial trade, 10 contracts. Step 2, it moved against us. What do? We sell the 11.5 strike put. And this works really nicely, right? Because using last week's trade as an example, we sold a 12 strike put for 29 cents a premium, which sticks us at a $12.71 break-even price off the bat, right? Which is good, 11.71. Which is good, right? If the stock never hits 11.71, you don't have to do anything. But we know the market tends to go down sometimes, and Ford got dragged down with it, and it dropped down below 11.71. So we say, okay, our break-even's 11.71. The stock's below that. How can we rectify that situation? There you go. Rectify. Better vocab right there from me. But we could sell an 11.5 strike put for 21 cents. And now, since we're doubling the position size, the premium that we receive right here is a cent for cent reduction of our cost basis. So this initial cost basis we had of 11.71 is dropped by 21 cents. And all of a sudden, we're in a position where initially we were breaking even at 11.71, and now we're breaking even at 11.50. And while 21 cents may not seem like a ton, right? I mean, the stock's only trading at like 11-ish, so 21 cents is pretty significant. And you'll find more often than not, like when you add these positions, that's very, very effective, right? Because initially, it didn't get back up to 11.5, so we didn't break even. But even though it continued to move against us, this new position that we added intra-week made us back 40 bucks, which, nothing to write home about. But I guess the point I'm trying to drive home here is these secondary positions we added, right? You could look at Peloton where we picked up 100. AMD, we picked up 76. They're not huge, but our new trades just last week alone made us over 3,000 bucks. So that's why we want to have some cash on the sidelines, right? This is all good and well, and if we hit max profit on a lot of these, like we looked at earlier, and these start running up, and we could take home almost $10,000 of profit, that's good. That's a great week if we don't have to touch anything at all. But we do always want to have that little trick in our back pocket. We've got a good question from NetV about starting capital suggestions. Should you start with $1,000? Should you start with $5,000? And I feel like it's weird to answer these questions like in the corner of the screen. Let's go back to the full screen webcam. We're good to go. So how big should your portfolio be when you're starting this strategy? And to be honest, you could start with as little as $1,000, right? You could start with 5,000. You could start with 10. I think that's the beauty of it, right? Now, we do have a larger portfolio, but we also started with way less than this and built it up through saving. I think personal finance is a very important part of this because being patient, understanding that we're not going for 500% returns in a year, but rather slowly compounding our gains over time to get this general upward trajectory in our account. And I pulled it up on my screen as if you guys can see, but there you go. General upward trajectory in our account. So that's kind of the battle that we're fighting. But really, I think, if you had like $100, it'd be tough to do. And 1,000 might be a little tougher, but it can be done, right? For example, if you're using a margin account, or even if you are selling things fully cash secured, you could have sold these SoFi 5-strike puts. You could have sold all 10 of them right there. Excuse me, you could have sold one of them. You could have sold one of the Peloton 7-strike puts, right? You could have come close to being able to sell one of these Ford 11.5 strike puts that we're talking about. So you don't need a massive account size in order to use the strategies that we're using. And I think that's a very, very important point to make. So yes, sometimes, these net profit numbers that we have, you're not always going to hit those, but from a percent return perspective, there's no reason that we can't have similar performance in that regard. Now, if you do have a smaller account, you're not going to be able to diversify between like 9 or 10 different positions, and that's just one of those risks that you have to accept, but it's much, much, much better than trying to take $1,000 or $2,000 at a time and build up that way. And I'm looking at my phone right now because I definitely fell into the fallacy of the idea that, back when I only had like a $1,000 or $2,000 account, oh no, I need to make this huge. I need to build this up instantly to 10K. But over time, just depositing my money on a slow, steady, and consistent basis would have done me much better. Here is my Robinhood account, and I think it's flipped, but it's a loss of almost $20,000. That's not from option selling. That's back from when I was buying options, but I still had that really that difficult mentality of I have this smaller account. I know where I want my account to be. I know where my account is right now. How can I build it up? And I really just ended up flushing away $1,000 at a time. So starting with that smart strategy, understanding that, look, the premium you collect on the first option that you sell, if you may only have $1,000 account, it may cover the cost of lunch, that week, which, whatever. But you need to be using a smart strategy. And I think the strategy you use at 1,000 shouldn't change from the strategy you use at 100,000. The only thing that should change is, the position sizing and the amounts of positions you have. But I think the approach should be the same, because if you're using something different at 1,000 in your account than you are when you have $150,000 in your account, why is that? There's not something that works better for having more or less money. If something works, and you just need to adapt based off your account size from a position of portfolio diversity. So that's what I would say. Yeah, option buying, never do that. But that idea of, I've got this smaller account, I need to grow this really, really, really quick. You'll do yourself so much better in the long run. And I'll tell you right now, I've built my account up decently. It'd be way higher now, just from a compounding gains perspective, if I didn't lose that 20K that I showed you a second ago on that Robinhood. So let's go back to the standard presentation here. I'm back in the corner of the screen. Where were we? Some good discussion tonight. Love the chat getting active here. And the best part about having my new laptop and the webcam is that I didn't realize that another, detriment of my really old crappy laptop is that it had like a minute delay in the stream. So I couldn't interact with anyone in the chat at all. This is great. I think we've only got like a 4 or 5 second delay, so much better, guys. But next on the list, Shopify, right? We liked it last week at a 27 strike on the money. So we love it this week at a 25.5 strike where we're getting 56 cents a premium. If Shopify holds above 25.5, let's pull up the Shopify chart. Let's draw the line. So long as Shopify stays above this number for the next 5 days, we're taking home max profit. Max profit on that trade is 280 bucks, so that's another solid one. Delta Airlines, right? We talked about Unity a second ago, being a trade where we've just placed it on Fridays and haven't really had to lift too much of a finger or put too much effort into it. Delta Airlines was great for us last week as well. We sold 5 contracts on the 28 strike put for 61 cents a premium. 305 bucks, didn't have to do a single thing for it. This week we've got a very similar trade set up. 28 strike puts, same exact put. Let me pop the expiry date on there again. 10/7 28 strike put. That gives us a break-even price of 27.28. Final answer, 27.28 break-even price. Boom, there it is. So in plain English, our delta position, as long as delta doesn't drop 2.78% or worse, we're going to make money off of it. And we talk about those levels. We brought up the Unity chart. Let's bring up the delta chart. I love the idea of this 28 price level, right? Because you're already seeing a decent bit of resistance, or support rather, on the downside. You're seeing a decent bit of support being built up on Delta Airlines here at this 28 level. We look at it from a 180-day perspective, extend this thing to the left. Guess what? This matches right up with where it bounced off of in June for the lows. So I think this is a great $28 level right here. And even better, right? We know that that's our max profit point, but since we received the premiums that we did, where'd it go? We know that our break-even price is 72 cents below that. So our break-even price, if we go to the 5-day chart on this, is all the way down here, which makes the value proposition look even better for us. So max profit here, profit period right here. And again, 5 days till expiry. It's a race against time for all these positions that we open. If we don't get a big move against us in a certain time frame, we're going to make money on these trades, and that's about as good of a value proposition as you could find in a market like this. And with how volatile last week was, right? It still didn't break 18. Futures just turned green. So maybe, I don't know, are we going to have a good week? I think we are due for one right now. But again, even if we don't have a good week, we want to have that cash in our back pocket. We want to have plan B for every single trade that we open. We've got plan B for all of these, right? We have capacity to scale up to another 5 contracts, right? All these 5 contract positions you see right here are going to be managed the exact same way. If our break-even price gets breached, add 5 more to lower strike, lower the break-even price, move the goalposts, let the rest play out. Peloton, this is one we took into the following week where we split the strikes at 7 and 7.5. I mean, this thing's just falling off the face of the earth. Now, one thing that we did here that I want to talk a little bit about, because I think it's an important defense mechanism, is we consider 20 contracts on Peloton to be a full position size. Now, what we did last week was we actually got up to 30 contracts at one point, so a 150% sized position. Now, why did I do this? Because of this huge red candle. But I think more importantly, when did I do this? I did this on Thursday. I would not recommend going over 100% position size anytime before Thursday. If you go over that 100% allocation to a trade, it needs to be Thursday, it needs to be Friday, it needs to be a 1 day to expiry option or a 0 day to expiry option, so you have that quick turnaround. But with that said, premium on Peloton still fantastic. Right? We've got those strikes split right there, but if it does drop further and we need to continue to play defense, I think if we hit 650, there's going to be plenty of premium to sell into on Thursday if we decide that we want to further increase that position size. But likewise, it's come a long way down, right? It's falling pretty hard. RSI is about as low as it's been in a while. When things get blue in the RSI short term, they come back up. So we put ourselves in a position where it doesn't even need to do anything crazy, right? It just needs to get back up to here for us to hit max profit on it for the coming week. So further down the list, what else we got in the queue? And the last thing is our UVXY position, which we already talked about. Love the idea behind these UVXY trades. Again, the UVXY theory, I guess the theory behind the trade, we've got a full-length video on our YouTube channel about it. Right now, again, it's definitely theory. We'll have some better numbers once we get a few weeks of this under our belt. But as of right now, I love the way that it looks. This break even range between 11.35 and 14.15, we remember. If we go UVXY, as long as UVXY on a 5-day basis stays between these red lines, that trade that we just looked at makes money. So I think this is a fantastic trade. I love the way this works, and we are going to continue to ride these things out. And I think the numbers, I don't want to get discouraged by losing money on it the first 2 weeks, because as we can see for what we have week 3, the amount of money we make at just max profit, I guess that's not really a thing. The amount of money we make at max profit is enough to get us back in the green. And I did also track an overall break even, right? So as long as this thing finishes between 11.93 or 13.57, our overall trade's basically going to be back to break even. So I think we're looking really nice with what we have set up right there. We're going to let that run for another week and just see how the numbers stack up. So again, that one's kind of in theory phase, but another one that was in theory phase was SPX, when we laid out all this math and shared what we thought our expected value was going to be. And we've been pretty close to dead on with the idea behind that one, as we crossed over the 15K mark in profit on our 0-day SPX spreads. We've got Jules making a bad Wednesday and Thursday prediction in the market. Jules, I feel like you got to send some more positive energy to the market, and we're finally going to see a little bit of a turnaround. Nice sip of ice water at the hour mark. That was fantastic. See, that's the great part about the webcam. Normally it was some dead air whenever I took a sip of water. We've got Holmes HC asking about Apple at the 137 level. Let's take a look at Apple at the 137 level. I will say I do have a little bit of beef with Apple and their valuation. So I mean, they're priced to keep indefinitely growing at just an insane rate. And couldn't that happen? Yeah. I mean, they're an absolute powerhouse of a company. It's a little bit better now. It looks like there's some. Let's get these lines out of here to do some better TA on this thing. We love areas of support, right? We want to figure out where this thing's going to stop. And Apple is in this really nice place where it's at the convergence of historically high implied volatility, which we can see right here, and historically low RSI, which we can see right here. So this is typically a great place to sell into positions. Now, the one piece of the puzzle that we're missing is a good identifiable level of support, right? So back in June, we have this bounce off of 129.04, which makes the 130 level look pretty attractive. And this level that we highlighted right here back in May, where it bounced, that's right back where it is. So the 137 level, not terrible. If we zoom in here, we can maybe see another level around 132-ish. But yeah, zooming in, we're going to have to zoom out on the chart to find those. Look, Apple's never going to be a bad stock to own. Now, what I do worry about a little bit from a macro perspective, if we back this thing up to the 3 years, that all these stocks that we've seen so far, like if you look at something like Square, right, it's back down to just below the pre-COVID peaks. If we look at Adobe, I'm kind of guessing here. There we go, way below the pre-COVID peaks. There's some of these larger stocks like Apple. You look at where the pre-COVID peak is, and it's down here. It's down at $80 a share. So I think there is, and this is kind of the big elephant in the room in the market right now, because Apple makes up, I think, 7 or 8% of the S&P 500. What happens if these larger tech names start to make the move down to the pre-COVID peaks, right? I think Microsoft, another really large hole. Okay, this has happened like 10 times on the stream tonight, where I just hit enter and a totally different ticker comes up. Microsoft has some downside to 187. Now, the gap there on Microsoft is a lot more attractive. We could take a look at something like a Google. I'm kind of curious as to where this sits, to be honest with you. Google, the pre-COVID peak 76, currently trading at 95, so a little bit better there. We could look at something like Meta, and again, a lot of people don't like Meta, but it makes decent cash. But Meta's back down to the COVID lows. So a lot of these stocks have made this move back down around or below the pre-COVID peak. Apple is one of the only ones that there's a really, really significant gap. So while Apple's like this super great blue chip darling stock and like never that bad of an investment, I do worry about, especially for the type of trading we're doing where we try to have these like 1, 2, 3 week turnarounds. And that's a great point, fridge opener in the Twitch chat. us already having a position in TQQQ, which is a tech leveraged index, is effectively us having exposure to this as well. So if we talk about the idea of portfolio diversity, that doesn't necessarily accomplish that. Now, if you don't have a position in any of those things, I'm never going to tell you there's anything wrong with jumping in to Apple at like a 130-ish level. Like you can get 1% ROR at 133. That's pretty phenomenal, especially for a stock like Apple, right? And you only have a $3 market maker move right here, which would put the low end of the range at about 135. So it's not a terrible idea. I just, for the context of our portfolio, what I worry about in the market, I don't love Apple. Now Meta, now that we had that stock up there for a second, is at least a little bit interesting, right? It's way down here. Obviously, the growth is leaving it a little bit, but the stock still makes some very, very good money. And if we took a look here, we could find 2% RR. Is this Meta? This is Meta. It's throwing me off for a second because it's almost the same price as Apple. We could find that 2% ROR that we like to potentially take out on a half-sized position. Now, the only issue here, obviously, is the price of the stock, right? It's trading at $135 a share. So even selling just one of these contracts takes about $13,000 of fully cash secured collateral. Now, on a margin basis, it probably only take like $1,200 of our buying power, but we want to keep that fully cash secured position size in the back of our heads just in case, shit hits the fan in the market. That's why we track it out here. So we say, if everything goes terribly in the market and stocks go way, way, way down and we have to take assignment on everything, can we afford it? If this number's under 100, the answer is yes. The big issue we ran into in January, and again, learning from your mistakes is so, so, so important. But the big issue we had in January is stocks went down, they kept going down, and then they got slammed, and we did not have capacity to take assignment on all of those positions. We were getting hammered. It's honestly kind of funny to see the fact that we were selling Peloton 21 strike puts off the back of Peloton 30 strike puts. Time flies, but that's the idea we're looking at right here. So yeah, I could get into the idea of Meta, but again, if we've got TQQQ, we basically have exposure to this anyways. So I think looking elsewhere for new positions. But while we're here, there's a lot of oversold stocks. There's a lot of volatility in the market. Let's hit up a nice little scan. So let's go to load scan query personal. We're going to go to high ROR puts without earnings. This is our just basic scan that gives us the highest option premium in the market. And if you want to get your own, if you use Thinkorswim and you want to have something similar for your scanner, where you can load scan query and pull in all of the ones that we use, we've got links for those available as part of HT Premium at hourglass-trader.com. Self-promo over. So let's take a look at the list right here. FaZe is insane at a 9.5 strike put, but we know FaZe is a former SPAC. We really want to stick to our rules. We want to avoid former SPACs. Honestly, we just keep getting burned every time we go against that rule. Blue Apron, kind of interesting here. I think this would only have this much premium if it just recently spiked up. Let me confirm that thesis. There's a green candle right there. What are we looking at? So it's gone from 4 to 6.5. Let's look at it at a 20-day basis. Slowly back the chart up, figure out what kind of downside we think we can get away with. Because look, for a 5.5 strike put, 10% ROR is enormous, right? And just because we see the 5.5 strike put at the top of this list doesn't mean that 5.5 strike put is the trade that we have to take on. We could take a look at Apron and say, okay, we know that if there's 10.55% ROR right at the money, there's probably decent ROR out of the money, and that's exactly what we run into when we see that there's 2.86% ROR on the 4.5 strike puts here on Blue Apron. So a 4.5 strike put can be sold for 10 to 15 cents, which will put your break-even price at 435, 440-ish, which is right around here. Now the issue, which isn't a huge issue, right? Because look, we could start with the smaller positions, scale in with the idea that we should be able to get our break-even price down below 4 pretty easily. Let's look quickly at the 180-day. Here's the bigger issue. This thing has tons of precedent for going back down here. Yes, on a short-term basis, could we get away with like a sneaky little low 4 break-even price type trade? Absolutely, and it probably would work, right? That's the thing about this strategy. Statistically, all of these trades probably will work, and that's why we have success in the long run. But the big issue is we don't want this to turn into like a stinker, right? We don't want to be chasing $100 and then turn into like a $1,500 loss because it goes back down to like 250 or 3 where we say, oh, I didn't know that could happen. But looking at this chart right now, we know it can happen. So if there's a big red candle or something, and look, we've seen this thing run just straight down, I don't think the risk on Blue Apron's worth it. AVYA, literally no idea what that is. AVYA. It looks like, I don't know. But there you go, 60 cents. That's a little bit scary right there on a 20-day basis. A little bit more stable if we take a peek at the news, see what's going on here. Intelligent video conferencing, huh? Very, very interesting. This one might be a little bit of a meme stock, which is not surprising at all to see. I mean, if you wanted to sell the 1.5 strike put, I mean, this is the definition of like a little bit riskier, but like big time reward. But at the same time, how risky is it? The worst case scenario, you get this stock with the basis of like $1.35, and you own the stock at this level right here. And the great part about these weekly options on these stocks with like consistently steady volatility at this range is that you can, this premium is not really going to go anywhere unless something crazy happens. So if you end up with like a 135 basis and take assignment, what you can do is just week over week sell something for 5-10 cents at a time and knock it down to 120, 115, 110, and all of a sudden a month later you're approaching a $1 basis. So honestly, that could kind of be a sneaky little AVYA fun trade to completely disconnect ourselves from the market. 60 cents is the low here, which is very, very scary. There's a pretty big gap down here back at the end of July. So, yeah, this is like where the risk comes in and makes this like a not so smart trade. But what I do kind of like about these sometimes is they're disconnected from the overall market. So if the market's dropping like 2% again in a week and just all hell is breaking loose, it's not going to impact this stock that we're looking at right here. Maybe going to keep in the back of my mind, but definitely not at the top of the list to add. A Wayfair is also very, very interesting to me at these price levels. I just do not understand why the premium is as insane as it is, but it is. So if we take a look at Wayfair, this is one that would be like just a pure premium money grab, right? The company is generating cash, legitimate business. If we take a look at the idea, right? We took a look at the idea earlier about returning to the pre-COVID peak. This one's almost back down to the COVID low. The pre-COVID peak on this one was like 110 a share. COVID low was 21.7, and it's at 32.55. What's crazy about this, if we look at it on a 10-day, it's been sliding off the face of the earth. It's gone from 46 to 32. We back it up to a 1 month. It's gone from 56 to 32.65. But with that said, that brings in some very, very large premiums. So you could put yourself in a situation, right? We like to target 2% ROR with a half-sized position. You could sell a 28.5 strike put, half-sized position, if we sell like 5 of those. That bag is like $300. And the 28.5 strike put for 50 cents of premium would get us down to like a 28 break even. So we have a trade, and again, let's look at this on a 5-day basis because this is how long the trade's going to last. Where as long as it stays above this red line, we're going to be making money on the trade. And even if it doesn't, what can we do? We could take that trade into next week. We could sell at the money call premiums for $1.60 and lower that down near 26. Shout out to Raylac for the follow. Appreciate that. But it's definitely a little riskier. I got to be honest, I haven't spent too much time looking at the actual valuation of this because like the one truth in the market is like, look, how much money is the company making? How does that look in comparison to the price of the stock? That is how you get comfortable about catching falling knives at certain price levels. I really wouldn't actually take too big of a bite out of this until I think that 21 level is going to be phenomenal. So if this thing just keeps falling off the face of the earth, I love that 21 level. But right now, I mean, so one of those where you put it on the watch list. If the market just keeps crashing, go to the watch list, add something like this, and just scale in out of the list. Question from Joe: any thoughts on BAC, which I believe is Bank of America Corporation, for a weekly? Let's take a look at BAC. Now, there's some uneasiness in financial institutions right now, mainly revolving around Credit Suisse. There is some. Is it Swiss? Credit Suisse? I don't know. I guess I'm not very cultured. But there's some uncertainty around that one. We can pull the chart up by typing in CS right here. This is what you'll notice. They've actually put some calls out to their clients, trying to calm their nerves, tell them to keep money in, but I think there's a lot of indicators showing that people are rapidly pulling their money out of here. Some rumors, I guess some speculation. I don't think, again, for the record, I don't think it's going to happen, but that they potentially could be close to going under at some point soon, right? I mean, this thing, it was a decent bank, but in a year it's gone from 14.95 to 3.92. Now there's a lot of issues with, there you go, right? The big rumor is that Credit Suisse is going to fail. Credit Suisse. Someone maybe needs to pronounce Credit Suisse for me as part of these rumors. But if you want to talk about levels on Bank of America, one, this 30 level looks fantastic. You've got a really nice, well-defined bounce here in July of 22. Let's get out of the 3-year chart here. There you go. The low is at 29.67, where there's a really clear bounce. If we zoom in a little bit, right, we like to start wide, narrow our focus as we move in. How about the 10-day here? It's starting to form a little bit of a base at 30. What's premium looking like? It's 2% at that 30 level, where you'd have like a 29.50 basis off the bat. Yes, this thing's gone from 34 to 30 in 10 days, but again, it's only a 5-day trade if you go weekly. And despite the sustained volatility in the market last week, this thing traded in a range during trading hours between what, like 30.20 and 31.82. I feel like that's all the conviction you need to kind of go for this one. And the great part about these is more stable stocks like Bank of America. From a margin perspective, right? Normally, if I wanted to sell one of these, it would take $3,000 of margin. This time, it's only going to take me $584. So that $54 max profit is now divided by the $584 collateral and gives me actually, a 10% return on capital. But yeah, Joe, you say you're selling those 29.5s, and yeah, absolutely phenomenal. You're still getting above that 1% ROR level. If you get a sign on the 29.5s, one, you're at a great level, and two, those have an even lower break even at 29.10. And if you look at Bank of America over the last 180 days, I mean, tell me 29.10 is not a price that you'd want to be holding that thing at. I think that's a great place to be. So Bank of America, good call out right there from Joe in the YouTube chat, but solid premium to match with low RSI. Increasing implied volatility means those premiums are going to be good. Maybe a little bit of risk in the financial services sector, but at the same time, we personally have a pretty tech-focused portfolio, so it definitely wouldn't hurt to add a little bit of diversity in from that regard as well. Speaking of diversity, maybe looking at some different areas, CLF, Cleveland Cliffs, the steel company, which those of you who are with us are probably very familiar with. We've already got 3 lines on the chart because we've traded this thing before. Used to have good premium. For a little bit of time, the implied volatility kind of backed off of it, so we backed off of it as well. But it's coming back up there, right? It's not as oversold as it was maybe a week or two ago, but I think it's at a very, very good price. If we go to live news, I don't know if we're going to see it. Any price targets? We've got a 23 price target, 32 price target, 25 price target, but that one's from Credit Suisse, so they may not be around to see that. Who knows? But if we look at the premium, right, it's 2.36, kind of dead at the money. The one issue I maybe have with this is that we've seen how quickly this thing can move, right? This is just a 1-month chart. It went from 19 to 12.9. If you go, we can maybe consider 13.5 to be right at the money. We can go out of the money to 13 and get that half-size position for over a 2% ROR. And that'd stick you with the 12.70 break-even price. So 12.70 break-even, I like the exercise of plotting these things on the chart because it gives you an idea when compared to the recent volatility of, okay, is this a good price to be in on this at? And yes, this would be a low for it on a 180-day basis. It would be a low for it on a 1-year basis, but it would not be a low for it on a 3-year basis. Pre-COVID high on CLF is like 850-ish, 8-ish a share maybe. That's a little bit scary, but this red line that we drew, and this is why we like to look at the longer term charts too, we see a bounce off this level, off this 13-ish level. So I don't hate the idea of maybe getting back into there too. Another one that has a very, very low margin requirement when compared to the full amount cash secured. So helpful from that perspective if you want to be a little bit stingier with your buying power. But maybe not the worst price level to get back in on this with. And again, it adds a little bit of diversity since this is like a steel mining company and gets us kind of out of that tech sphere. That's why we added Delta Airlines. That's why we took a look at BAC, but that's why we're taking a look at CLF as well. And Zim is maybe one other one. I remember mentioning on the stream, we're going to wait for this thing to get to the low 20s. And it's kind of finally there. Now, the thing about this is a really, I mean, fundamentally, this stock was so good for so long. And it kept running up. And this had to do with supply chain constraints. And they're kind of, their revenue, their forecasts, their guidance are kind of at the mercy of shipping rates, which when we were having a lot of supply chain issues in the economy, those shipping rates, those were going way up. So they were just crushing revenue. In fact, their dividend is 4.75 a share, which, you know, sounds good when it's at 90, but now that it's at like 23, that's almost an effective dividend of like 100%, which is just insane. So I imagine that's going to get cut at some point in the near future. But with that said, it's coming back down. This low 20s level is where I wanted to get back in on it. I mean, we've previously sold puts on this thing in like the 40s. So low 20s is a massive discount. And further, there's some really nice ROR here. You want to go to that half position, 2% ROR. There's your stop right there. It's at 21.5. Zim, I believe they are variable dividend if you take a look, right? They paid 17, they paid 285, 475. But like when you're doing the dividend scanner or whatever, it just uses the most recent one. So when I was taking a look at it earlier, when I was doing some research from that perspective, that was the one. But yeah, variable dividend, I cannot imagine it's going to be 475. Last time I was at this price level, I mean, it looks like they paid out 349 and 513 back at this price level back in front end of 2021. So who knows? But one where now that it's at the low 20s and we could kind of get our feet wet at a 21.5 strike, which would give us a 21 basis. Again, we'll zoom in on that chart, 5-day perspective. Give me that 21 basis. Draw the line on the chart. That looks fantastic to me, right? And yes, this thing could continue to slide, absolutely. But again, the idea with all of these trades that we enter into is that even if it does continue to slide, it's going to have to go pretty far to get down to this 21 level that we want. So what we could do right there, sell some of these at the mid for 50, sell maybe 5 of these, bag ourselves $250 of profit off 3,700 in collateral. There we go. We've got Petty Bourgeois correcting me in the Twitch chat, saying the numbers we're looking at on the 3-year chart were their earnings, not a dividend. And he or she, I don't know who Petty Bourgeois is, to be honest. The anonymity of Twitch. But yeah, these are these are earnings. You're dead on. Last time they paid a dividend, I mean, was $2 when it was at 45. So I can't imagine that 475 level stays. Great catch, keeping me on my toes. Love the fact checkers in the chat tonight. But Zim, another one if you want to get outside that sphere of the normal stocks that we like to look at. That's another one. We're gonna wrap it up with one of my favorite scanners, which is just this general one, right? We have this general scan that objectively brings us the highest ROR puts in the market. But as you can see right here, we have 947 different results. We simply do not have time to go through 947 different options. So what we're going to do here is the intersect feature. I love this feature because you can intersect it and say, okay, there's all sorts of things we like to look at for different stocks, right? When we pull these stocks up and look at the chart, we can look at X, Y, and Z. Well, let's filter the list so that we get X, Y, and Z on the list and we don't have to do that extra step of research. So if we go to personal and intersect this with oversold stocks, again, that's another preset you can get off of our website, hourglass-trader.com. Hey, glad people are loving the webcam, man. I know we're gonna try to get the production value up. Right now it's camera 1, camera 2, camera 1, camera 2. That's all we got right now. That's the extent of our stream tech. But we're gonna see if we can maybe up the production quality a little bit here. Baby steps, baby steps. I think it took me like a year to get a webcam. So that was definitely dragged my feet on that one for a little bit. Anyways, we've got this intersection here, right? We intersected it with HT oversold stocks. This is going to give us, of that 977 option list, which of these are oversold? So at the top of the list is Wayfair. And honestly, I didn't know that. But we already looked at that one. And a great example of, look, when you have something that shows up on this scan list right here that's intersected, you're going to pull up Wayfair. What are you going to see? You're going to see a couple different things on a 1-year chart. You're going to see relatively high implied volatility because the option premium's high. You're also going to see in the blue on RSI. IV high, blue RSI. I mean, I think that's the second unintentional rhyme we've told on the stream tonight. We are on fire. So what do we do with that information, right? I think RSI from a short-term perspective is maybe one of my favorite technical indicators. Because we look at Wayfair. I mean, very similar trend I mean, I would almost call it between here and here, but the skid honestly was from November of last year. But the last time we saw it kind of get into the blue down here, and it did get into the blue here as well in April 27th. And what happened in the next few weeks? Jumped right back up. And again, jumps back down, but gets into the blue. What happens when it gets into the blue? We're not always going to get this big rip back upwards, but we'll remember when we're selling options out of the money, we don't need that big rip back upwards. All we need is just to trade flat, and that's exactly what happened last time it got in the blue. Again, similar setup. We're in a downtrend. When is the downtrend going to end on a 1 year basis? RSI is now back into the blue. So what are we going to see? Hopefully a short-term bounce. But again, I don't know if I love the valuation at 32 because I don't know much about the valuation at 32. While we're on the stream, let's have an opinion on the valuation at 32. So the first thing we're going to do, W stock. We're going to figure out the market cap. It's $3.46 billion market cap. Next thing we're going to do, we're going to go take a look at their financials. And anyone can do this. You go to SEC Edgar, Google that, type in the ticker Wayfair, pops up right there, hit the search. We're in. We've hacked in. Next thing you want to do, figure out what is more recent between the 10K or the 10Q. The 10K is a better document because it's annual earnings, going to be a lot more comprehensive. But 10Q gives us what we need, and it was filed August 4th, so relatively recently. And what we're looking at is a, just beautiful, it really catches the eye, this 10Q right here. Really nice black and white layout here. But what this is going to give us is the unaudited consolidated financials. There it is, statement of operations. This is what we want. It's the income statement. So a couple things to keep in mind when you're looking at the income statement is what unit things are in. This is in millions. So if you see 1,000, that means billion. And two, what basis you're looking at things on, right? So this is 3 months ended June. This is 6 months ended June. So if you want an annual figure to base the valuation off of, multiply this by 4, multiply this by 2. Now we're all caught up. So net revenue, if we want to look at it from a revenue perspective, 3.2 billion in revenue. Some concerning trends here is that's a decrease from 2021. Now, what I will say is with Wayfair's business model, and this is similar for a lot of online e-com businesses, 2021 with the pandemic, it really helped sales, I think. And a lot of these companies caught on in that regard. But when you're looking at valuation, if there's a steep valuation and you're seeing a decrease in growth, that's not great. But with that said, 3.2 billion in net revenue. So we're going to pull up our handy dandy system calculator here to do some really complicated math. For those of you who have made it through elementary school, you probably should be able to follow along here. So 3.3 billion in net sales in 1 quarter times 4 quarters means we could roughly project out about 13 billion in sales. So that's pretty solid, right? 13 billion in sales. That means if it's trading at 3.46 billion, it's trading at like a third or a fourth of sales. So from a sales perspective, that's a very cheap stock. Let's continue this exercise though, because sales are not the end all be all of the income statement. The end all be all of the income statement, as you may have guessed, is income. In 2021 for what is this, Q2 for them? Yeah, it is Q2. They had 131 million in net income. Which is good and well because if we pull that calculator back up, I should have never gotten rid of the calculator. 131 million, good Lord, hit about every number there. 131 million times 4, that's 524 million. And if you had 524 million in annual revenue and you were trading at 6 billion, that's a decent valuation, right? Or we're not even trading at 6 billion, we're trading at 3.46 billion. So it'd be 3,460 divided by whatever 500 that we just saw right there. That's a 6.92 price to sales, or price to earnings rather, and that's very cheap. The S&P 500 is in the high teens right now, and historically is in the teens. So anything teens or below, I think is a decent valuation from an earnings perspective. However, the issue here, as we alluded to a little bit, or maybe not alluded, we directly said it when we talked about revenue. The big issue is the lack of growth. And that lack of growth has gone from you basically lose 600 million in sales quarter over quarter, I guess year over year, comparing that quarter. And you look at expenses, what's this line right here? OPEX jumps up 300 million. That's concerning, whereas the jump, it's in SG&A expenses, which you're not going to be able to tell a ton from here. They took a 40K impairment charge, which is, you could ignore that for valuation purposes. But yeah, it looks like This is larger SG&A costs despite lower sales, and that really is not what you like to see. Cost of goods sold is lower with lower revenue. That makes sense. Gross profit is still kind of in the ballpark, but the issue is we walked down to like a $378 million loss on Wayfair. That's a problem because if you annualize that one, what you're getting is about a whatchamacallit, over a billion, like a 1.2, $1.3 billion loss. Deadloof in the Twitch chat. Yeah, VOD is going to be up on Twitch. Also, all the streams are recorded and put on our YouTube channel. So if you have to pop in or out at any point, that's where you can watch the replay. So to play devil's advocate a little bit here from the valuation discussion, let me actually zoom in. You guys feel free to tell me, hey, HT, this is like 3-size font because I'm streaming on a monitor and it just kind of goes over my head. But you might say, okay, maybe they just had a bad quarter. 6 months right here, the loss is even bigger. So what this tells you is that Q2, yes, there was a loss, but it's not like Q2 was an anomaly. Q1 was also bad, and they had a very similar loss to get them up to a $700 million loss. Now, that is about as, surface level of an analysis as you can do on an income statement. And in an environment where rates are rising, valuations are getting crunched, this is not a trend you want to be investing in. So yes, you could say, oh, well, it's trading at like a fourth of sales. That's very cheap from a price to sales perspective. Absolutely. But at the end of the day, there's one true intrinsic valuation in the market, and it's the amount of money that the company is making. And this is a really, really bad trend. This is something I'll probably have to dig into a little bit more. But, they might talk a little bit about it in the MD&A section where they have the notes to the financial statements right down here. And this is a very typical MD&A section that you'll see in a 10Q or a 10K filing, talk about significant accounting policies. Here we go. As of June 30th, 2022, they reported accounts receivable. Now that's AR, balance sheet item. We don't worry about that. Contract liabilities impairment. We're not worried about that. Or cash valuation. Let's see what else we got here. Debt, not worried about that. Sorry if this is some boring air right here. I'm trying to see if there's any information that could potentially impact the income statement. Let's see what we got right here. Looks like they also have some notes that can be converted into equity that could further dilute the stock. This just looks like a disaster. We could go looking somewhere else for something good. But yeah, I mean, from a numbers perspective, Wayfair looks great. As far as like technical indicators and RSI and IV is concerned, you probably could get away with selling a 27 or whatever, what was the number, 29 strike put for 2% ROR and not even have to worry about it. But we always want to have that, what if in the back of our minds. So that if Wayfair went down to 20 and we're like, oh, well, we knew that was going to happen because we looked at the financials. We don't want to lose money. We don't want to be right about something and lose money. So if I think this stock's going down, I don't want to touch it. Back to the scan, we've got Zim on there. I mean, talk about coincidences. We've just, all the stocks that we had in the back of our mind. Good question from Deadloof. What's ROR? And ROR is return on risk. And, that's kind of the quintessential metric that we like to look at for all of these trades that we enter into, right? Because when we're investing, we're looking for a return. And when we come up with our investment and shape our portfolio at the beginning of the week, what we should do is structure it in such a way where we're generating good returns that are going to annualize to nice numbers and get us to targets that we think are good on a weekly, monthly, or yearly basis. So when you look at ROR, this number is calculated off of the fully cash secured amount. So if I were to sell one of the 29 or one of the 30 strike puts, it would take $3,000 of collateral. We'd make $100 back. That's a roughly 3.18% return. And that's how we look at that. Now, there's all sorts of other factors that you could throw into the mix. If you want to talk about margin, you could pop into return on capital, which is a much bigger number because your denominator for the fraction is a little bit lower with margin enabled. But, the more conservative, less clickbaity way, more realistic way to look at things is ROR. So that's what we look at. We're not about the clickbait here. We're about a realistic, consistent, compounding, smart approach to the market that's going to give us long-term success. And while we only have a little bit over 2 years publicly tracked, that's what we've seen. We've seen long-term success. We're outperforming the S&P 500 and NASDAQ by over 100% since we started publicly tracking our trades in July of 2020. And it's all around ideas that we're talking about on this stream. So let's finish out the exercise here. I think XPEV is like a Chinese electric vehicle company. This shows up on this list a lot. And if you've heard me talk about that one before, I just think risk with China stocks, or Chinese stocks rather, it's just not, it's not worth it, right? Just put that money somewhere else. It's like the discussion we just had with Wayfair. There's so many different options and different trade opportunities in the market. If you're looking at one, because mentally I've definitely been there before, you could stare at something and do all this research and say, oh, I spent 30 minutes looking at this. Surely there's a trade I can, figure out. If you're not in love with every single part of the trade, the level, the return you're getting, where RSI is, the price point, potential assignment, if you're not excited about every single one of those attributes of a trade, don't enter into that trade, because there are a million trades out there. Find something that you love, because the worst thing is when you have a week ruined by a trade that you really weren't too committed to in the first place and said, okay, well, that was a stupid decision that I regret. Moving down the list here, we got WDC. I think this is one that's appeared on here before. WDC, Western Digital. Yeah, I really had no idea what was going on with this one, but RSI is getting very, very low on it. Let's take a peek at the live news. They've got a sell rating on there, 28 a share. I mean, if you got banks issuing sell ratings, and I think a lot of those analyst ratings, like, you want to make sure a stock has a buy rating. In a market like this, even a hold rating is a bad rating. If you have banks actively giving sell ratings, look, it's these people's job to cover the stocks. Don't waste your time doing it. Head to the hills. Scanner VZ. Let's take a look at VZ. Verizon Communications. There we go. We see this same pattern. We've got a price target at 40. 40. Let's see if we've got any other price targets. 47 from Credit Suisse. And one other thing we could do really quickly is pull over our Discord server, because we've got, instead of trying to scroll through the news feed, we could just type this in, DD analyst on VZ. Did I type that in right? We'll find out in about 3 seconds. We did. So here are the most recent issues, or I guess issued price targets. 3 downgrades in a row since the end of July. Price targets 41, 51, and 44. Not the greatest thing in the world. I mean, let's take a look at the option premium and at least finish out the exercise while we're here. And you've got 3 downgrades in a row on a stock where implied volatility is higher than it typically is. You've seen it run from 55 down to 37 just between April and now. And you're not even getting 2% at the money. I mean, I guess you are, because 38 is technically at the money. A little trick right there was 37.97, so it's technically in the money. But yeah, you're barely getting 2% at the money. That's just not anywhere near close enough to the kind of cushion we'd like to look for. If we look at the 3-year basis, this thing is in the gutter. Probably leave that one alone. And yes, when stocks get oversold like that, there's probably a certain reason for it. But again, we still have the ability to say no to certain trades. WM, is that waste management? You playing a ticker guessing game tonight? It is waste management. This is honestly weirdly similar to the Apple chart that we looked at earlier, right? We've seen the trend of a lot of stocks getting back to pre-COVID peaks. That's 127. This is hanging out at 160, and if we draw a line at this price level, that doesn't line up with a ton, other than maybe this stretch back at the beginning of 2022. If we go to the 180 day, it might look a little clearer. Yeah, I don't see a bounce on this one until 138. That's a long way away. You can maybe look at this as a level of support, because we see a bounce here back in March, another bounce in July, so maybe 150. But I will say, even though I initially kind of shut down that price level, with areas of support and resistance, this clearly acted as resistance before. 160. 160 is a nice round number. There's a psychological aspect to that as well, but this was an area of resistance. It then got broken through, and this is very, very common to see once resistance finally gets broken, massive green candle. But it's coming back and retracing back to that former level of resistance. And when you see that, former levels of resistance become levels of support. So I got to be honest, with where IV is here, with where RSI is, this 160 level, let's finish the exercise real quick to just get some analyst ratings on waste management and see what the people are saying. We've got an upgrade, but it was, pay attention to those dates too. We've got May and April. Upgrade, downgrade, that's from 21 though. That's a while ago. We've got a downgrade to market perform with the 174 target, 153. So 160 is kind of in the mix there, admittedly. So maybe we could do 160. Let's take a look at the premium. But look, we're back in a situation where it's 160. So 160 is truly at the money here. And that's 1% ROR. And again, I don't love that 160 level. I'd like 150 a lot more. So maybe keep an eye on it, throw it on the watch list. But I still don't think with the huge pending disaster that you could potentially see on the 3-year chart here, this might be headed towards. $2 a premium per week on this at the money is nowhere near enough to manage the type of risk that I think we could potentially see. XSP, WDC, nothing else really that I love on this list. So that's the scanner. Nothing too exciting came out of that, but no worries there because we've got a really, really full portfolio, right? Think of the things that we really want to keep at the front of our mind as we head into the upcoming week. Is one, the market can always get worse. So because of that, how did we address that fear? We sized down on positions where we could. Examples like last week where we had 10 contracts of a firm. This week we only have 5, and we could make still a decent amount of profit, while at the same time we have that flexibility to add back to that 10 position size in case the market continues to slide. And again, if the market doesn't continue to slide and we never get to use that cash and we say, oh no, I wish we had bigger positions, that's a great problem to have, because the problem is that we could have made more money than we already did. And those are the types of problems we like to set ourselves up with in the market. So the only thing we really need to do is sell covered calls on open door, and I'm waiting for a bounce on that. Everything else, we've got the boat loaded nicely. If you're late to the stream, we talked about this all up front, so you could watch the replay on Twitch or on our YouTube channel. But I like what we've got set up here, and we could always let's finish the stream by playing the fun game of, since these are all formulaically linked, what would it look like if we got a little bit of a bounce in the market, right? I can absolutely see DraftKings getting up to 16. If SoFi gets back to 5, AMD goes 66 maybe, if Firm goes 19. Maybe 3.3 on open door. And if TQQQ, it's leverage. So if we get some green in the market, that could bounce to 21. Unity, it doesn't even need to move for us. If Ford goes to 11.5 even, which is not that big of a jump. Shop doesn't need to move. Delta Airlines doesn't need to move. If Peloton even just gets 30 cents back this week, this is what our profit looks like, right? The market has dropped 2.92% plus 4.58% plus 5.17%. Now, this isn't perfect math, but the market has dropped about 12.5% over the last 3 weeks. Over the last 3 weeks, we would then be in a position where we've made $1,000. So that is great. And right, it's a 12.5% drop on the way down. It's not going to take a 12.5% bounce on the way back up to get us back to break even, right? We don't want to get greedy. Step 1 is breaking even. Step 2 is, continuing off that momentum, resetting the portfolio a little bit, and then continuing to make new highs in the account. We could look at how we've done since April against the S&P 500. We adjusted our approach to have a lot less of the heart attack inducing swings up and down, to be a much more sustained approach up. Yes, we're going to run into a speed bump every now and then, and it was a pretty significant speed bump. But all things considered, it was also a really significant slide in the S&P 500 and NASDAQ. Yet only one of us, between us and the larger indices, is positioned to get right back to where we were 2 weeks ago, right? So I think this is a great example of how we've averaged in. We've lowered our break-even prices week after week after week. We're putting ourselves in that position to where we could hopefully catch the bounce, right? We talk about RSI. We've talked about RSI, half the night tonight. RSI is 35 on a 180-day basis. That's 3 years, geez. It's 28 on a 1-year basis on the S&P 500. This is begging for a bounce, right? Last time it was this low was back in January of 2022, and we ripped from the bottom of 420 up to 457 in the matter of a week and a half. Back when we got that low on RSI. So just hang in there. Again, things can always get worse, and we're prepared in case they do. But the way we have these positions set up, we are also in a hell of a position to catch that bounce. Question from Aaron: haven't kept up with your portfolio. Are you still leaning bullish with the cash secured puts, or are we delta neutral with call credit spreads on SPX? So generally, yes, we are all over the cash secured puts. Admittedly, every single week our portfolio is bullish. And the idea behind that with our investing strategy is there are not a lot of certainties in the market. In fact, I think on a daily or weekly basis in the market, the movement is pretty randomly dispersed. But one of the only, I mean, maybe the closest thing to a guarantee in the market is that over a long enough time frame, it's going to go up. So if we pull up the old SPY stock chart, hit max, take a deep breath, because yes, this big drop from the top is significant. Don't get me wrong, it is significant. It may seem like the end of the world sometimes. But look, we're hanging in there this year. If we get this recovery we want, we're almost breaking even on the year, despite the fact that NASDAQ is down over 30%, the S&P 500 is down 25%. But over a long enough time frame, the market's going to go up. So in general, we want our portfolio to be bullish. And we do hedge it a little bit, right? Like what we did last week with the SPX spreads, I thought was great. We just kept hammering these call spreads over and over. And we did mix a couple put spreads in there as well when the market started dipping. There's 3 of those, 4 of those actually, that all hit, despite the fact that the market was red last week. And that's how you just play that intraday RSI. But in general, using these call spreads as a hedge is great. It's not going to hedge the entire portfolio, but even just $300 a day, knocking those SPX spreads out is fantastic. Because with the amount of volatility in the market right now, you could go about 1.5% out of the money and bag $300. So you could put yourself in a position, and it's exactly what we were doing last week, where we said, okay, we're going to sell these call credit spreads on SPX with the 37.25 short leg. But look, if the market runs up to 37.25, we've got all this stuff above it that's going to crush it if the market gets that high. So losing like $300 or $400 off this call credit spread is the least of my worries. And it was a very, very effective hedge. And these all work together, right, to give us like $3,000 of profit just from SPX last week, which powered us to a really, really successful week. So we do try to make things a little bit more neutral as of late, especially off this bounce, or off the slide rather, with SPX. But we hope to get that bounce eventually. Having those call credit spreads be breached would be fantastic. But again, we're in position for a really, really nice week, even if we just get a little bit of green in the market, and that's the position we want to be in. Because again, macro perspective, 1-year basis, S&P 500 RSI is showing there at 28. It just broke a lower level of support. We definitely think there's precedent for it to get back down to the 340 level, so we want to remain a little cautious. But if it takes off from 357 to 370 next week, we absolutely want to be the beneficiaries of that. And looking at what would be a roughly 10K week accomplishes that. So this is base profit, right? This is how we evaluate our trades. It's if the market goes up, if the market goes down, I feel like equally likely. So the way that we evaluate things are, what would our portfolio look like if nothing moved? And this is what it would look like. If no stock moved next week, we're taking home $3,390. And that's why I love this strategy so much, right? Because what drives this number down over the next 5 days, which is a tight time frame, downward moves in the market, right? And we have our break-even tracker out here. We have to have these level of drops on some of these names in order for us to lose money on these positions. So it has to happen quick in a 5-day time span, and it has to be a decent move down, because we've got some decently large break-evens right here. But again, if it goes our way, this number gets bigger. So that's our base profit. It's a race against time, and we will let the week play out. We'll be in our Discord server. If you want to join that, hourglass-trader.com. I added a new button, so it's right in the middle of the screen. You just click on that right there. Oh no, this button doesn't work. All right. Tech support, aka myself, will be fixing that after the stream. That explains a lot. I duplicated the button. I didn't fix the link. Pretty impressive for me right there. But you could also join HT Premium. Quick bit of self-promo at the end of the stream. Less than $1 a day on a monthly basis. We give you all sorts of info. You can come join our Discord server. We've got a really active daily premium chat where we talk about things. We announce every single one of our trades as we make them. So you could follow along, learn from us doing exactly what we do as we do it. We also, what else we got? We've got some IV reversion bots. So there's certain situations during the day in the market where their premiums are out of control, a little bit in a lopsided sense. This calls those out. Every time there's a stock call, it gets called out here, and you can be alerted as well. Just a really nice tool to have in your day-to-day trading. And again, that's the end of the self-promo, hourglass-trader.com. But with that said, that is what we've got set for the upcoming week. Our goal right now, right, we want to have short, medium, long-term goals. Obviously, the long-term goal, that's an easy one. It's to outperform the market. Short-term goal right now for us is to get back to break even by the end of October
and I think it's a very attainable goal. We only lost money in September because of that one really bad week. The way our strategy is working, the way premium looks in the market right now, obviously that's one speed bump, but we've been on a pretty consistent roll with what we've got going on right there. And you add the wheel type trades in with what we're doing with SPX, where we've taken home 15 grand since May. We've got this new UVXY idea, which I think is going to work really nicely for us. I think we've got a really nice outlook for the remainder of the year. We didn't get crushed. We didn't take ourselves out of the game with that newest dip to have new lows on the year in the market. We're still in the game. Our blue line's still up here, red and yellow. See you later. But this is what we got, and we are gonna wrap it up after almost a 2-hour stream. Appreciate you guys tuning in. Definitely a lot more fun with the webcam and having the chat up and being active and being able to interact with you guys. So appreciate everyone who tuned in. But until next time, hold on, camera. There we go. Some nice editing right there. Until next time, this has been the Hourglass Trader, where as time passes, we make money. We'll see you guys next Sunday, hopefully with more money in our account than we have right now. Thanks to everyone who watched, and see you next week or in the week in the Discord server once I finish that. Once I fix that button on my website. So thanks, guys.